Hey guys, welcome back. In today's video, we are talking about how shorts failed, the OBV squeeze, the 1000% short volume, and many more in this video. First, we're taking a look at this. When AMC sneezed, its fundamentals were 90% worse than they are today. They made a move to win the float back and failed. So now they're using every angle they got because if AMC doesn't go bankrupt, a lot of these hedge funds are going to go broke. Not only does the United States currently have the biggest debt refinance in its history, its swap monkey partners, aka hedge funds, have to do the same. And now what we're essentially talking about is understanding how when you look at AMC today and you look at AMC a few years prior, it is at a lower price than it was before, even though the fundamentals are better. And this is what we've always said in terms of understanding why AMC is extremely undervalued. Because even when we look at the past, when we looked at AMC at its high price, no one ever actually said AMC was overvalued. If anything, when we saw AMC at its previous highs, the actual price targets that was given said that AMC should be even higher. So if we compare where AMC is at right now, in comparison to, of course, wherever you're looking at, wherever it's when AMC was at 160, wherever it's at 180, or of course at the high of 392. Remember, at those times, there were higher price targets that were given when the shorts weren't involved, but also when the fundamentals weren't as good as they were currently. And so this is why I've always talked about in terms of why I said AMC is extremely undervalued. And so that's because the shorts are, of course, suppressing when the unsettled fundamentals right now actually means AMC is supposed to be a lot higher. And when you take a deeper look, and we talked about the biggest financial nuke ever existed, it's essentially looking at the OBV. Now, some of you may get tired now because we keep on looking at OBV, but the OBV is very important. And you can even see here, AMC OBV now pinching and about to cross upwards, where, of course, we're looking at that volume kicking in. Now, the biggest reason for why we are looking at OBV is essentially seeing whether or not the retails have sold, because at the end of the day, what makes us win, what allows us to win, is that the retail investors haven't sold their real shares, haven't sold the float back to the institutions. Now, I've already said before in the past that the possibility of over 80-90% of the retail selling their AMC shares is extremely low, close to zero. And the only reason why I'm not saying it's impossible, I'm just giving a bit of a leeway here. But precisely because of that, when we are focusing on the OBV, when we understand that the investors are still holding onto their shares, meaning that every time we are buying shares, it's because they're creating new synthetics, it just means that the short squeeze will be even bigger. It just means that when they buy back the shares, the floor price will be even higher. And what we can also understand in terms of the volume that's coming in to obviously beat these hedge funds. Another thing to look at is the short volume for GME, 1040% short volume. So recently what we are seeing is the short volume for GME to be increasing. Now, it isn't a surprise when you also take a look at the fundamentals of GME. As always, it isn't a comparison of which company is good, which company is bad between AMC and GME, because at the end of the day, we know that the short sellers are both involved with AMC and GME. And so whichever one squeezes first, the other one will follow along with it. And so if anything, if we're AMC supporters, we do want GME to squeeze. And if we're GME supporters, we want AMC to squeeze. But at the end of the day, both should be in the same trenches. Both are in the same team. And going back to the fundamentals of GME, what we obviously understand is that they have billions of dollars in cash. Whilst they don't have a successful business structure like AMC does, they do have a lot more cash than AMC, and that's how they're able to collect interest. And if they were to obviously expand into different areas, depending on their new business structures, obviously we'll see that they have a lot of power to do so. And so both the fundamentals of AMC and GME is extremely deadly towards the institutions, towards the short sellers, and hence why we're always seeing the suppression. You're going to be looking at spoofing, you're going to be looking at large amount of short, but that's all with the purpose of pushing down the price to create an incentive for people to sell, but clearly the shorts have failed. You can also see another thing. Interesting message when trying to buy HYAMC today could be nothing. Now, the reason why HYAMC is involved is because we obviously talked about the cash pile. We have to understand is AMC is obviously an investor of HYMC. And so if HYMC were to increase a large amount, one of the benefactors will obviously be AMC. And just like we said how GME is in a very good position because they have a lot of cash, so would AMC. If AMC were to be in a position where they have a lot of cash, I do believe that they will do better than GME. Because the reason is because AMC already has a mature business structures. And so if they had more cash, they could obviously expand the business ventures that they have. And again, on the other hand, of course, dividends and whatnot, paying off the debt and whatnot, these are all good things. And so when we are seeing the limitations, now, like I said, and just like this user has highlighted, this could be nothing. But if they are worried about AMC getting their hand on a large amount of cash because of their investment, then stopping HYMC would be a way to do so. So obviously keep this close in mind. Also, you have to understand in terms of why AMC isn't pushing up. So we talked about earlier on with the OBV pinching. Now, essentially what this shows is obviously that buyers are still in, that the people who've bought their AMC shares have not sold their AMC shares. And we're also seeing that people are continuously buying back into AMC and buying more and accumulating more of AMC. But one of the biggest reasons for, despite the fact OBV is high, so despite the fact we are seeing that people have not sold their shares, people have, continues to buy shares, why isn't the price going up? Well, right now there is too much spoofing for AMC to run. It's been covered in the official spoof report so many times. Because of how many shares the shorts have and the spoofing algos, it requires a ton of bids slapping the ask for this stock to move. So because of all the manipulation, all these algos that have been ran on AMC, what it means is that it may require us 5 times the normal amount of buy pressure to actually allow the price to go up. It may require us 10 times, 20 times, etc., etc. Because we're seeing how a lot of the buy volume is being routed into the dark pool, not hitting the lit exchange. And so therefore what it means is that every 5 shares that's being used, that's being bought of AMC, maybe only 2 shares of that actually provides the buy pressure, and so the other 3 doesn't. But every 3 shares that's being either sold or shorted, if all 3 shares are hitting the lit market, then the net, of course, would be negative. It means 3 shares sold, but only 2 shares bought, despite the fact it was actually 5 shares bought. And so that's why we talked about it requires a lot more. And so whilst the shorts still have the money to obviously run these algos, to run these spoofs, we've covered about how they're lacking liquidity, about how they're going to be failing to do so in the future. And when that time comes, all the buy volume that they've hidden and everyone who will continuously to buy, that will allow the price of AMC to obviously push up. You can see how damaging naked shorting is when you look at this. Naked shorting, Merlin has evidence of naked shorters destroying their company. The stock is currently one of the most shortest stocks in the US after dropping from $30 to 0.25 in 2025 alone. Short interest 190% with nearly half the shares being shorted. And so this is a look at how deadly, and how much of a negative impact naked shorting can have. And so the reason why I say that we're always going to be seeing these news and why we look at AMC and GME is because we have managed to not only survive naked shorting, but obviously fight back. Yes, our price have obviously taken a hit, and that is something that we can see. But in comparison to Mullen and other companies, we are still surviving. Now, the difference you will see is when you see a stock that's dropped from $30 to 0.25, you don't actually see that many FUD news on Mullen. When you take a look at the comparison of the news that you're exposed to, you're very likely to be seeing more FUD, more negative news on AMC and on GME. Now, ask yourself, if both companies, or if all 3 companies, or whatever companies we're looking at, so if we're comparing Mullen and AMC, if they're all seeing the price go down, then technically, and again, this is in the eyes of the shorts, then that means we should be bad companies. But why is it that for a successful naked short onto Mullen, which has dropped their price, we're not seeing that many news? But yet for AMC, we're seeing so many negative news. And that's what we've always talked about. It's because they understand they can't push us down any longer. They understand that the naked shorting may have worked on other shares, but it doesn't work on AMC. It doesn't work on GME. Their investors are still here. The fundamental shows that AMC should be higher. And that's why we don't see these news targeting Mullen. They're successful naked short victims. But on AMC, on GME, we continuously do so. And so that's why, like I said, they are still trapped in this play, and that's exactly what highlights it. Now, another thing, credit card defaults for small banks are near record levels. This is higher than even the peak of the 2008 financial crisis. So if you really want to look at how big of a problem it is for liquidity, for banks, for institutions, for the capital that's in the market, well, this essentially sums it up. And if you are worried about the overall economy, whole healthiness, then you should be. But that means if we are able to see institutions to be recalling back the loans from institutions to cover up the holes of these credit card defaults, then we're going to be looking at some shorts obviously covering their shares. But yeah, guys, thanks for watching. I'll catch you guys next time.